Good Wednesday morning, 30 minutes until the start of trading. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, the stock rally losing some momentum as fresh ADP numbers kick off 3 big days of economic data.
And Washington is tightening its grip on Venezuela's oil while tensions simmer from Greenland to China and Russia.
Plus, with financials sitting at record highs, we'll get ready for earnings with a read from Jefferies today, Wall Street's earnings bellwether.
Matt, kicking it off with one of the stocks in focus, not one we ever talk about, I think, is fair to say.
A company I hadn't heard of until this morning.
Yes, it is called Critical Metals. Let me show you what it's doing. So yesterday, Matt, it surged 25%. It extends those gains this morning, 5.6%, because the Trump administration apparently is exploring options to acquire Greenland. And this company, Critical Metals, its flagship project is in Greenland, mining for critical metals, as the company name would suggest.
It's so weird. Like, would it do better if we owned Greenland? I mean, it's already...
I guess. That's actually a very good point. What would change for it if we owned Greenland? Maybe it gets all of Greenland. It can mine the whole thing.
Yes, the whole island. 3 times the size of Texas, folks, with 60,000 people. Memory and data storage stocks today are down as AI news from CES shows insatiable demand for these chips. We saw them roar higher, in some cases 20% gains. Here is SanDisk, for example, 28% over the past couple of days. So taking a little bit of a breather, maybe investors taking profits just a tiny bit after the massive rise in these stocks, which were the best gainers of 2025 as well, Dani.
So yeah, Jensen Huang adds more fuel to that rally. I mean, he's been moving stocks all weeks with his comments at CES. Now, to those specific ones, he said that demand for AI-related products will accelerate with his company's technological advances.
From Hopper to Blackwell, we increased energy efficiency by 10x. From Blackwell to Rubin, we increased energy efficiency again by 10x. And that translates directly to our customers' revenues, because in the case of an AI factory, whatever factory size you have, you're limited by the power.
Let's bring in Bloomberg Tech's Ed Ludlow at CES in Las Vegas. Ed, fantastic conversations, and it is amazing just how much those memory chip stocks moved off the back of Jensen Huang's comments, that this is where the real bottleneck is. Just how big of a problem and how big of demand did he lay out?
Yeah, I mean, to be clear, what we're talking about is memory in the context of storage, not memory in the context of high bandwidth memory, which goes around the GPU. We're literally talking about the need to store data, the models that already exist. And, you know, SanDisk is the easy example and the gains that we saw in it. This is par for the course. It happened again last year at CES when Jensen was the keynote speaker. You know, he talked about specifically high bandwidth memory, and that caused Samsung to have some stock moves. Other places we've seen the market move in the other direction to the downside was part of that explanation of the design of Vera Rubin. It has no hoses, no fans, and no cables. It is 100% liquid cooled, but that liquid is at 45 degrees Celsius. It doesn't need to be chilled. So you saw all sorts of parts of the supply chain falling precipitously when they realized that NVIDIA's kind of moved on from this established server design base of suppliers that supply literally hoses, fans, and chilling equipment because NVIDIA doesn't need them anymore. The main message after the interview that I had with Jensen Huang was that, you know, demand is fully intact for GPUs. And if you guys remember in October, they gave a $500 billion figure for the next 5 fiscal quarters just for Blackwell Rubin. And the answer to whether that could go up is yes, it could probably go up.
I guess I'm getting too old because, Ed, you know I'm an air-cooled guy at heart. I want to ask about Warner Brothers. We expected them to say, no way, Jose, to Paramount because the amended offer didn't raise the price that shareholders are going to get. So what's next?
So the story here is not good enough, but also too risky. You know, we're talking about a revised $30 a share offer from Paramount Skydance for the entirety of Warner Brothers, including the legacy networks. But in their sort of correspondence from the board in rejecting that revised offer, they flagged the debt load, an unprecedented leverage buyout which carries risk, and question the ability of Paramount Skydance to get the deal closed. So some regulatory risk there. The point of contention is, how do you value the cable networks? Because if they are not of any value, then Paramount Skydance's bid of $30 per share would represent a big premium on them, which Paramount Skydance would argue is an attractive offer. But lots of people on the street and many investors would say, actually, you're undervaluing those cable assets, in which case your $30 a share offer is not attractive. And that is kind of inherent in the letter that Warner Brothers Discovery have put out today. They also note the kind of structure of the guarantees that Larry Ellison is giving, without sort of opining in the direction of whether that's in the pro or con column. But that's the summary, Matt. Not good enough on the price, risky on some of the structure and the debt.
All right, Ed Ludlow covering TMT news for us out of CES. Bloomberg Tech kicks off at 11 o'clock today. Stick with Bloomberg throughout the day for interviews from top voices at CES. That is the biggest tech conference in the world in Las Vegas. Palmer Luckey, the founder of Palantir, co-founder of Palantir and Anduril, joins the show later on today. Yep. By the way, Ed sometimes is seen behind the wheel of an air-cooled Porsche, which is why I thought...
That was your reference.
Yes.
Yeah, I wonder what percent of our audience was like, of course, Matt is talking about Porsches and air-cooled systems.
It could have been a decent amount. Let's turn, speaking of automobiles, to the oil market. Prices are dropping after President Trump announced Venezuela would relinquish almost $3 billion worth of oil to the U.S. Energy Secretary Chris Wright addressed the situation at a conference hosted by Goldman Sachs.
We're going to let the oil flow, sell that market to United States refineries and to around the world to bring better oil supplies, but have those sales done by the U.S. government and deposited into accounts controlled by the U.S. government. And then from there, those funds can flow back into Venezuela to benefit the Venezuelan people. But we need to have that leverage and that control of those oil sales to drive the changes that simply must happen in Venezuela.
Bloomberg senior editor Michael Shepard joins us now from Washington. So, Mike, it looks like the Trump administration expects Venezuela to give us 30 to 50 million barrels of oil. How significant is that, and how's Washington reacting?
Well, you heard the Energy Secretary add a little bit more detail to the president's Truth Social post last night when he said that up to 50 million barrels of Venezuelan oil would be handed over to the U.S. It was unclear from his post last night what exactly that would look like. Would it come from future production or from storage? And the secretary said this morning it would come from storage. And there has, thanks to the U.S. blockade, been a backlog building in that storage. So it may be able to go to U.S. refiners like Phillips and Valero fairly quickly, provided they can get the ships there and get that crude transported to those refineries in the southeast U.S., where they have the capability to handle the heavier sour crude that comes from Venezuela. He also made an important point about what would happen with the proceeds. He sees the money actually flowing to the U.S. and then eventually flowing back to Venezuela, giving the Trump administration some leverage, the secretary said, to exert the kind of political change it would like to see in Venezuela following the ouster of Nicolas Maduro as president.
Even after that ouster, Shep, the U.S. is still taking what some may call very aggressive action in the region. This morning, the development that everyone's been following is this Russia-linked tanker, the Marinera, which, by the way, is a Peruvian dance, not the tomato sauce, for those wondering what that's named after. Shep, what exactly is going on here? What's the latest that we understand?
Well, this is the extension of efforts to enforce this blockade around Venezuela. Remember that Venezuela is still subject to U.S. sanctions, and not just anybody can go in there and buy oil. You need permission, and there has been this blockade going back to last month, seeking to prevent ships from just showing up there, offloading cargo, and taking off for ports around the world. And this vessel known as the Marinera was one of those that had sought to escape the blockade, and it had been tracked all the way up to the North Sea between Iceland and Scotland by U.S. and U.K. forces. And today it was boarded by U.S. Special Forces. The European Command of the U.S. military announced the move today. It was done in conjunction with the Justice Department. This is over sanctions violations, as I said before, and it would have had to have been carried out in heavy seas. And we have to watch, Dani, also what this might mean for relations with Russia and also with China as well, because China is one of the biggest buyers of Venezuelan oil.
Just stunning developments going on there.
But it took so long to catch up to that tanker. It must have been super fast.
I can feel your sarcasm. But these are complicated ships to seize, right? Maybe they caught up to it, but to get a ship of that size, to get control of it,
I feel like the U.S. military, the U.S. military could accomplish that goal in less than 3 weeks. But I could be wrong, and we're going to talk to Wayne Sanders from Bloomberg Intelligence a little bit later on, former military intelligence officer, to talk more about that. Let's get right now, though, with our stock market strategist. Michael Ball joins us, macro strategist from the MLive team. This is interesting, the oil play here, and it can't be unexpected, right? That this is part of the goal in removing Maduro is lowering oil prices. Remember when President Biden was selling oil out of the strategic reserves to get cheaper gas to win votes for the Democrats. Now President Trump is also aiming for the same goal.
Happening at an interesting time, too, because we were just starting to get our inventory levels higher for gas, diesel, the rest of the product basis. And this means that with more oil coming in, more refinery options, that gas prices at the pump will fall even further into the election season, which is exactly what the administration wants. So good timing. We already kind of have this supply glut story overhanging the oil market, which has been linearly driving prices lower. Now we got to start looking at our own production in the U.S., whether it's in the Gulf or in the sort of Permian and the Midlands and all those places, of whether this $50 price starts to shut production down, and do we really get capped here under the 14 million barrel a day level we've been at, or we've been around 13.6 to be really clear. But do we start coming off now because it's just not profitable anymore for U.S. producers, and hence the benefit at the pump sort of is also capped, meaning that we don't go too much lower.
But, I mean, isn't 50 million barrels that they're seizing, isn't that like just 2 days of oil? Like, how big of a difference does it really make, even though you did see a reaction in U.S. markets in the price of crude yesterday?
Right, so we know Venezuela is about 1 million a day in production. I thought they were a little less in floating inventory, so this is coming off the land, which is a little bit more opaque. So again, to your point, it is going to trickle in. It will make a difference on the margin. All this is adding up. And plus, with Russia, not necessarily this story with the ship, but with the war in Ukraine potentially coming to an end, that'll also flood the market a little bit more, maybe another million and a half from the shadow fleets and actually becoming legitimized. All this, along with what OPEC is doing, is just putting further pressure. And then, as we know, it feeds into inflation. It makes the Fed's job more easy. It just moves the narrative to a more easy financial condition story and less costs and less pressures and all that.
All right. Michael, thanks very much for joining us. Michael Ball there from the MLive team. You can check out his work by typing MLIV Go on the Bloomberg terminal. Let's get a look at some of the movers in the pre-market this morning, and they're few and far between because, as you can see at the index level, there isn't a lot of movement. 986 on futures right now is barely budged. We did hit another all-time high yesterday.
Yep.
So stocks have been strong thus far in 2026. And
they have.
We're giving up a little bit of those gains.
Yeah, some big trends in memory chip stocks and financials. As for what's moving this morning, Mobileye, this is an autonomous vehicle company. They're buying an Israeli startup called Menti Robotics. It's a cash and stock deal valued at $900 million. So it joins the likes of Tesla going into humanoid robots to the nightmares of many. Mobileye founder and CEO will be joining Bloomberg Tech at 11 a.m. New York time.
Alaska Air is buying 110 Boeing planes in a global growth push. You can see Alaska up 2% in the pre-market and Boeing gaining 1.4%.
And finally, Wall Street Journal story, Eli Lilly in talks to acquire an immunology drug maker Ventex Biosciences. It would be for more than $1 billion.
Coming up, Carlyle's Stephen Wise joins us at the table to discuss his outlook after helping fund the largest private equity-backed IPO of all time. This is Bloomberg Open Interest.
Medline shares currently remain well above their initial public offering price in the new year. They debuted last month, and Medline jumped more than 40% in the biggest IPO of 2025. Not only that, it's the largest private equity-backed IPO of all time, owned by Blackstone, Carlyle, Hellman and Friedman. And joining us now is the man behind the deal, Carlyle co-head of America's corporate private equity, Steve Wise. Steve, thank you so much for joining. Well,
thank you for having me.
What a great note to end 2025. And what's been a really busy year for Carlyle, with many IPOs succeeding many of your peers. But with that, it feels weird to say that like private equity needed a win, but it kind of felt like that. Did this giant IPO into the market do something to reawaken animal spirits and confidence in leverage buyouts?
I think so. I mean, it's just a great business to start with. We're super proud to partner with Jim Boyle, the CEO, and the Mills family. It's just a big battleship business, and it's no surprise it had so much success with public market investors. One of the things I always ask my team when we make an investment is, does the business have a reason to exist? And if it disappeared tomorrow, would anybody care? And you can answer that resoundingly yes with Medline. If Medline did not exist, you'd have a healthcare crisis in the United States. So we try to invest in businesses that are really important in the ecosystems in which they operate. And I think that really resonated with investors.
You know, I'm not as deep in this as Dani is, but whenever I would see her or guys like you at Super Return over the past few years, I would hear that exits are few and far between, or fewer than you'd like. Is that going to change in 2026?
I think it is. You know, exits have not been an issue for us. It's something we've been very focused on. We actually have more exits, I think, than any of our peers. $12 billion in return capital in the last 2 years, globally in private equity. You know, I think 2025 was a tricky year. There were a lot of headwinds. You know, you had tariffs, you had DOGE, you had an environment where people really didn't know the direction of travel around interest rates and inflation. And so, at least as it related to IPOs, there was a little bit of a risk off from investors wanting to invest in IPOs. And then private equity in general, in terms of exits, there was a disconnect between buyers and sellers in terms of price expectations. And I think now that the clouds have cleared a lot, DOGE is over, the tariffs are behind us, the impacts were not bad, economic growth was good, margins have expanded. There's more of a meeting of the minds between buyers and sellers, and I think you're going to see activity begin to accelerate. You did see M&A up, I think, about 40% this year, so you're already beginning to see that in a big way. That was a lot of larger deals in that as well. So I think 2026 is going to be set up for a very good year, both within private equity and just corporate M&A in general.
I wonder if that's the case, though, just across the board. And I ask this specifically about the really expensive tech that a lot of firms bought in 2021 and 2022. Are they in an environment where they're also going to be saved, or are they going to be holding on to companies that they just paid too much for and are going to struggle to exit?
Well, I think the issue when people talk about the return of capital in private equity is due to a large amount of investment in tech. So I do think that is still an issue. Some of those prices that were paid in 2021, in 2022, we haven't gotten back to those multiples. So I think that is one pocket where there will be harder to exit. I think you're beginning to see a broadening, though, in the market. You're seeing a lot of interest in industrial. You're seeing a return in healthcare, financial services. And you're seeing that in the stock market as well, as you feel broadening of valuations across those sectors. So I think across the market in general, you're going to see a really good environment in 2026.
I've noticed that, PE lately has been almost like VC in terms of its interests, with tech companies. And when I was a kid, it was about buying, a business that maybe wasn't efficiently run or was mature, and the original owners didn't know if they could get any more out of. And you work that magic and do that. Do you expect that kind of broadening out to really pick up this year? And which industries do you think are going to be most interesting outside of AI-driven tech?
We do, and that's what we've been focused on, quite frankly. For us, I think one of the biggest areas is carve-outs. And in the last year and a half, we've done 3 very large carve-outs.
Automotive paint.
Yes,
for
BASF.
Yeah.
Vantive as well, which is a big healthcare carve-out as well that we did. That's a big area for us. What we saw is when interest rates spiked a couple years ago, corporates were really rethinking how they allocated their capital, and they pivoted a little bit to doing carve-outs. Then you reached an environment again in the last year where there was a big investment in AI, in automation, in supply chain resilience, and corporates needed capital to do that. So carve-outs was a way to do that. In fact, that's really spending on R&D and CapEx. So while M&A has returned in the last year, M&A as a percentage of capital allocation by corporates was only at 7%, which is at a 10-year low. Now, as we go forward and we look to next year, we're really seeing that companies are looking at AI and what are the implications of AI for their business. And they're looking at maybe M&A as a way to expand their scale, expand their scope. And that's another reason why I think more corporates are going to be looking at carve-outs so that they can raise capital and focus on other priorities. So carve-outs is a big area of focus for us. In terms of industries, industrial is a big power alley for us. Again, reshoring, supply chain resilience, automation, a lot of big trends in industrial that we focus on. And healthcare is a big area of focus for us as well. Life sciences, the convergence of technology and life sciences, we've had a lot of success in. And lastly, as you know, given our roots in D.C., defense is really important. We, I think, are the only large private equity firm with a dedicated aerospace, defense, and government services business. We have some really interesting assets there. We're spending a lot of time there as well. And obviously, as the United States has sort of given up being the global security financier, there's been a pivot to Europe, and there's a lot of interesting opportunities that we're looking at with our colleagues in Europe.
I mean, even in the same vein, if they're giving up being sort of this global power, they're not in the Americas with this return to the Monroe Doctrine, or Monroe Doctrine, as Donald Trump calls it. Does that change at all the opportunity set or the attractiveness of companies? If this is a U.S. that's returning to a more aggressive style of foreign policy, again, at least in these continents?
Yeah. Well, there's lots of opportunities for us to invest in the U.S. given that context. We have a recent investment called Exeger, and it's in the supply chain risk management space. It's the convergence of AI and supply chain risk management. We can look at, for any company in the United States, who their suppliers are, who their suppliers' suppliers are, who their suppliers' suppliers' suppliers are. So we can tell you where a screw comes from, what country. It's a really important thing as you look at issues around national security and supply chain resiliency. We're looking at a lot of interesting opportunities in the United States in that vein.
I wonder about, you mentioned reshoring, and we've seen something of a manufacturing recession, but it's early days, obviously, and the big, beautiful bill has a lot of incentives in it for manufacturers here. Do you see that really picking up in 2026? Do you see businesses making more stuff here, and are you a part of bringing them over?
We see that slowly happening. We do see a general resurgence in industrial. We see the ISM going over 50 in 2026. There's been a lot of headwinds in the industrial sector for a few years. People have been waiting for that to turn. So we think that is going to happen. But there's a lot of opportunities just generally around automation and things like that. We've got a really interesting business called Duravant, which is making equipment around automation to make our plant infrastructure around the United States more efficient.
Does it make it more complicated, or is it helpful that this is an administration that's taking a more active role in companies, in corporate America, when it comes to things that matter for security and defense and things of that nature?
Well, certainly change always creates opportunity, and we've got a lot of expertise in Washington in terms of navigating the halls of government and partnering with government, whether it's local, state, or federal governments, to have partnerships, corporate government partnerships. So I think it can be helpful. You know, we're living in a complicated world, and complexity creates opportunity.
Steve, great having you here with us on set. Really fascinating business. Carlyle's Steve Wise talking to us about his business in corporate M&A specifically. Let's get a check on what's going on with futures ahead of the opening bell here. Very little on S&P futures, but again, we hit an all-time record high on stocks yesterday, judged by that broader benchmark index. NASDAQ futures are down a little bit, but a lot of that has to do with the huge gains that we saw in memory yesterday, right? We're just getting up some of those gains, but it's only exactly. So if it's off 2% today, it doesn't really make much of a difference.
Yeah, it's been a huge move. And coming up, we're going to talk about more of where to be invested in this market. We're going to talk with Lazard's first chief investment officer, Eric Van Nostrand, joins us right after the opening bell. That comes in less than 4 minutes' time. You're watching Bloomberg TV.
We are moments away from the start of trading on this Wednesday. It's the first full trading week of 2026, and it's been a good year so far. Right now, S&P futures are flat, but the cash trade hit an all-time high, another all-time high yesterday on the S&P. The Dow Jones Industrial Average also hit an all-time high yesterday. The NASDAQ is getting close. It's near as damn it to a high, and right now futures are down 0.1%, so that's not a lot considering the movement under the hood, which we'll go through. Coastal States Bank, I should say, ringing the opening bell at the New York Stock Exchange. It's got an IPO, and that's an old school, organization. A lot of men there. But fronting the NASDAQ, you've got a women-first business here, Lyra, a mental health business, ringing the opening bell. It's great to see a huge panel of women there. A couple guys standing in the back. I, too, would do that.
Yeah, go to the back.
Stand behind those women,
Yes, I like it. More of that at the NASDAQ, please. My plea for that.
You're looking at a company that we sort of first heard about after the explosion in shares yesterday.
Yes, I was going to say, less than 24 hours ago. I think many people are hearing about this company for the first time. Its name is Critical Metals. The main thing it does is it explores critical metals in Greenland. That's its flagship operation, so you can see why shares are gaining 11%. It gained 25% yesterday, extends the Trump administration exploring options to acquire Greenland, so presumably would be good for an American company that's already in Greenland, Matt.
Yeah, definitely if you have the Trump administration behind you, we've seen from stock movement last year that it can really boost your business. Sure. Memory and data storage stocks, today they're mixed. Like SanDisk, as we've been talking about, down 3%, 3.25%. But that's no big deal because the news out of CES, the tech conference in Las Vegas, blasted these shares off yesterday. SanDisk, over the last 2 trading days, gaining 25%, so adding a quarter to its market cap because of the insatiable demand that we have seen and Jensen Huang says we will see for compute. And let's bring in Lazard's Chief Investment Officer, Eric Van Nostrand, today, I guess, promoted yesterday to run this business, and I was going to say inaugurated, but it's not a political position.
That's my old business.
Yes. Yeah. Talk to us about how you see 2026, because I don't think anybody has come out with a negative outlook. Literally everybody's bullish this year. Is that a concern?
Yeah, I mean, I think these changing dynamics in the market are why my job is so interesting, why our work at Lazard is so interesting, is the same playbook rarely works from year to year when you're navigating these markets. 2025, in my view, was a big change from the markets we all grew up in. I think investors working today spend most of their lives thinking about demand management. Are governments going to deliver enough fiscal stimulus, enough monetary stimulus to stoke demand to get us out of a recession? 2025 was really about supply shocks. On the upside, the question of how much value AI is going to deliver to our ability to make stuff. And downside supply shocks from the United States' very changed policy relationship with the rest of the world. 26 so far looks like it's off to a similar start, where supply is really driving the story as developments in Venezuela give investors different ways to think about the geopolitical risks.
One of the interesting things about what you're doing at this moment and the creation of the CIO role, I know one of the things you're implementing is an IC, an investment committee. And I understand that's more about bringing the parts of the business together, but I wonder if there's also something about today's markets that make healthy debate and an investment committee more necessary than ever.
That's exactly right. I think Lazard's been a successful company over the past couple decades because we've had a diversified set of investment strategies that our investors, our portfolio managers and analysts have been able to come up with different ways of solving these big problems. In these environments, we need to keep leaning into that. We need to keep leaning into a diversified approach to figuring out what's going on in the world. But my job, and what do I want to accomplish at CIO, is really make sure we're staying on the forefront of maximal debate, maximal challenge to our views. I want our investors fighting with each other constantly about what these questions mean, because it's changing the way we think about the whole world.
Oh my, to be a fly on the wall during one of those. I want to hear the debate happening, Lazard.
We're happy to come. It can be
You're welcome anytime. You're welcome anytime.
Eric,
cameras or not.
You mentioned your previous job at Treasury, and we were talking with Steve Wise just now at Carlyle about the big push into defense and I guess security is really the overriding theme, right? Peter Cheer from Academy Securities talks about security, and this administration has really pushed in that direction. How excited should investors be about this whole prosec sector?
Well, I think the way we've seen these policy developments evolve over the course of 2025, it is a very different modality of engaging with the rest of the world from the United States. And it's been about surprise, as we saw with the tariffs last year, as we're seeing with this push now. There are elements of U.S. policy that weren't in the market consensus beforehand. And investors need to figure out how to incorporate those shocks in new and different ways. There's upsides and downsides, because a lot of this does create more productivity growth to get American companies and global companies producing more. But it also, by reducing the confidence with which countries can trade with one another and investors can bet on countries managing their supply chains and getting the cheapest possible goods from abroad, that's harder than it used to be. So the risks are higher, but also I think the returns are higher.
But it's almost like preparing for a war. And I don't mean that in a negative way. I just mean in the mechanics of identifying assets that we don't have good access to or that we can't produce here, and ramping up production of that for our security and our safety, from microchips to critical minerals to just the manufacturing that Steve was talking about. I mean, isn't that kind of exciting when you look at past preparations that our country has done like that? It has massively boosted productivity.
Yeah, so the way I think about it, and this is similar to the way I think about it today as an investor is similar to the way I thought about it when I worked in government, is you're managing trade-offs. You're managing trade-offs from an economic principle that says a more globalized world delivers more value for everybody, because we're allocating costs to countries that can produce things the most cheaply. But in many cases, including the ones we've seen in the past couple weeks and including over the past couple decades, the tensions we've seen between the United States and China and the way China has produced critical minerals and other products at significantly lower cost. The national security concerns are a real counterweight against some of that. And governments need to make sure they balance that. Investors need to figure out how governments are going to balance that and make sure it's consistent with their clients' overall economic interests.
Well, one of the other outputs of this, though, has been what metal prices have done. Copper at records, nickel at records, because of this concern if you start to get more hoarding, plus more usage because of the industrial build-out we're doing. The last time we saw a commodity super cycle was in the 2000s, extending into the next decade because of China's reindustrialization. Are we about to head into something similar? Another time where the overall ramp up in commodity prices has an impact on markets overall?
Yeah, so I think the causes and the effects of the commodity moves are both really important and for different ways. The causes, to me, this reflects the supply constraints I talked about when we started our conversation, is that the investors see uncertainty is much higher. Investors don't really know how to navigate with as much confidence the shocks that we're experiencing this year and last, and that's contributed to much more hoarding, much more store of wealth in these all conventional real assets, right? And I think the effects of that element, as we see more and more retail investor money, more and more institutional money piling into commodities, is that it's going to change the way that investors think about their marginal risk in equities and bonds.
See, this is the thing. When Venezuela happens, when Trump talks about Greenland, it is a market that is very happy to just brush it off. Is that kind of the wrong approach? I know in the past, geopolitical risks haven't really impacted risk.
Right.
But this sounds like a sea change, a paradigm shift that we're undergoing.
Yes, the way I think about it, and this is really my background as a quant investor, a big important part of our work at Lazard. Statistically, when a geopolitical shock happens, historically, you're better off assuming it'll be fine. That's been a good approach because usually it is fine. But that doesn't mean you should do that every time, because when you have that tail risk manifest, you're going to see a real negative outcome. And what we've seen tested over the last year and a half, even though stocks are at an all-time high, even though investor confidence in the United States remains pretty high, is those risks are showing up in different ways. And that long-term supply story, how much is the world going to be able to produce in a less globalized world, that's in more question than it used to be.
Eric, this has been so interesting. You have to come join us again soon.
Please.
Definitely want to continue the conversation.
And I'm going to take you up on a couple of our meetings.
I was going to say, we'll see you at your IC. Can't wait. Lazard Chief Investment Officer Eric Van Nostrand. Congrats again on the newly appointed role. All right, let's get a check on your equity market right now, about 10 minutes into your trading day. Breadth is pretty evenly split between gainers and losers. We're only 0.07% higher, but that is another all-time high considering we hit the number yesterday. Microsoft, Alphabet, NVIDIA lead us to the upside. Eli Lilly, that's one of the better performing ones too, up 3%. A Wall Street Journal story that they are buying a company that makes immunology drugs, a very hot area of biotech. Looking to the downside, Broadcom falls 1.3%. JP Morgan falls after a huge record run for financials. We're going to get earnings kicking off next week. Jefferies we get tomorrow is kind of an indication of where we're going. We're going to talk to our reporter about that in just a moment. Let's look at some of what the sectors are doing, what's gaining and what is losing in terms of the S&P 500. Healthcare does well. That's Eli Lilly carrying the healthcare sector across to the best gainers. Materials, utilities, financials, energy, consumer staples, those are at the bottom of the pile this morning. Maybe because of some of the ramp up that we saw yesterday means that stocks like materials aren't doing well. But again, Matt, we are posting just ever so slight gains for the S&P 500.
All right, so maybe another new record today at the close. Coming up, we had an exciting show yesterday out of Las Vegas. So we're going to go back today because CES continues and we still have Ed and Caroline down there. Bloomberg Tech is going to go to CES. We're going to cover it as well on Bloomberg Open Interest. Stay with us.
Let's look at the top calls this morning, what the analysts are upgrading and downgrading. First up, a downgrade. This comes from Jefferies. They've cut for solar, saying that tariff support is weaker than hoped and that it doesn't support current expectations. They also flagged limited visibility into 2026 and saying there's not a lot of policy help ahead. Those shares fall 7.6%. Next up, Oppenheimer. They upgrade McDonald's to a buy. They say the company is emerging from 2 weak years with a clearer value message and a stronger innovation pipeline. I don't know what that means for a company like McDonald's, but the firm sees earnings growth this year. Please do not tell me McDonald's is AI. Everything is at Caterpillar's AI. So yeah, your robot burgers, I guess. I don't know. Anyway, it makes it one of Oppenheimer's top restaurant picks alongside Chipotle and Domino's. Finally, Piper Sandler, they upgrade Hershey to a buy because it's an AI company. No, I'm just kidding. They say that easing cocoa costs and the removal of cocoa tariffs give the company more flexibility to invest in growth, setting it up well for the year. Those shares up 1.5%, Matt.
All right, headlines out of CES, speaking of AI, are moving stocks related after CEOs make product announcements and comments from this one from Bloomberg's interview with AMD CEO Lisa Su.
You know, we think we have to increase compute by another 100 times as you go over the next, 4 or 5 years. And I introduced a term last night, the yottaflop. People are like, what is a yottaflop? A yottaflop is actually 10 to the 24th in terms of flops. So that's a 1 followed by 24 zeros.
Learning the minutia of AI and compute every day. Let's bring in Bloomberg Tech's Caroline Hyde at CES. She's there in Las Vegas where they will broadcast their show again today. Caroline, so what has been, to you, the most exciting thread out of this conference so far?
Oh, that's such a tough one because there are so many myriad of threads. I mean, whether you've got lollipops that play music as you eat them. That's particularly, I don't know how much AI that is, but that's a tech innovation my kids are going to love. Or whether it's massage chairs, but really what it's about is where we're getting driving and the focus really on self-driving, and that has been a key area. Robotics, thick and fast in the humanoid area, and we're going to be speaking with Mobileye CEO a little bit later about their new purchase of a humanoid robot company. But more broadly, it is about the furious need for certain components within the AI trade. It's all about the rampant run-up in memory prices. You had Samsung, president from Samsung on our airwaves last night, talking about the fact that they're going to have to jack up prices because they're seeing memory just becoming so expensive, but they also dine off of that because they make the memory chips as well as have to produce some of the consumer electronics that you put them in. But that's really what has lit a fire under some of the stocks you've been looking at, the SanDisks of this world, up 1,000% off of its lows. Now up 50% thereabouts in the first 3 trading days of the year. No one can stop talking about the fact that memory chips are getting so expensive. But no one can stop talking about the fact that really it is all about the semiconductor companies here. Jensen Huang really led the charge. But Lisa Su, what more is a woman to do? She invents a new terminology, yottaflop. She's talking about 100 times increase needed in compute over the next 4 or 5 years. And still, her stock falls for a second straight day. I guess you have to put into perspective that it's up 70% over the course of 2025.
Caroline, I'd also love to talk to you about an excellent scoop that you had yesterday, and that is Discord filing for an IPO. What did you learn?
Yeah, I learned from people who are familiar with the matter that Discord has filed its documentation with the Securities and Exchange Committee. That, of course, is confidentially. Eventually, it will become more public, some of the data that they're in of those documents as they head out onto the roadshow. But this is, of course, a 10-year-old chat company with its origins in gaming. They've got a new leadership, new CEO at the company that comes from Activision Blizzard. They've put their ducks in a row to be able to go public, maybe even as soon as March is what we're hearing from some people in the market. But this is going to be the fire that is lit in 2026. IPOs. We've talked about it, how even SpaceX is looking at a $1.5 trillion focus to come public in 2026. I've been speaking with VCs here. They're looking at OpenAI going public. Maybe we're looking even at Anthropic going public. Even 2026, maybe beginning of 2027. But the IPOs are going to come thick and fast if these valuations still stand, guys.
All right, Caroline, very much looking forward to your program. Again today, Bloomberg Tech's Caroline Hyde coming to us out of CES. And for coverage really all day, you can tune in to Bloomberg Television. We have an interview coming up with Palmer Luckey of Anduril at 4 p.m. New York time, which, well, sometimes they prove to be very exciting, these interviews with Palmer. Coming up, Jefferies is set to kick off financial earnings reporting after the bell today. It's become somewhat of a banking bellwether, so we'll take a look at it next with Cato. This is Bloomberg Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Quick check on a new world record for the S&P 500. Right now, it's only up 0.08% at 6950, but that's all we need to achieve a new record today. The Nasdaq 100, although futures were lower, actually gaining. It's only 0.1%. But again, from a pretty high level. Nasdaq didn't hit a record, hasn't since October, but it's darn near it. NVIDIA, one of the reasons we're seeing those gains, up 0.6%. Ed and Caroline spoke with Jensen Huang yesterday, and he has been causing, AI obviously been causing a lot of love for memory makers like SanDisk, currently down 4%, but over the past 2 days, SanDisk has gained 25%. Mobileye, there's a lot of talk about, well, there's an acquisition with Mobileye, and there's a lot of talk about autonomous driving coming out of not just Tesla, but also Mobileye, also AWS, also NVIDIA itself talking about autonomous. Boeing getting an order but not moving much. Robinhood down after, again, this is a story of a company, a stock that's giving up some huge gains. Robinhood was one of the biggest gainers of 2025. Over the past 2 years, Robinhood is up over 800%. So it's been massive. And then Jefferies. Let's talk about it right now because Jefferies is coming out with earnings, Dani, after the bell.
Yeah, and you can see it's lower there, but it hit a new record yesterday. The entirety of the banking index, the KBW banking index, also hit a record, and all of that comes ahead of Jefferies' earnings. And we're joined on set with Bloomberg finance reporter Katherine Doherty. It's always kind of the first read we get for the banking sector. What are the expectations looking like?
So we're going to be looking for two things. One, how the year ended, any commentary around the activity, which just given the IPO momentum, debt and equity issuance, also trading activity. This is all going to be a positive towards Jefferies' overall revenue growth. They are at a core an investment bank. They're not going to be reporting as large numbers as JP Morgan, B of A, other banks that are reporting next week. But the commentary is really what we're going to be looking out for first and foremost. And it's not just about 2025. It's going to be, how does 2026 look, the year ahead? So what kind of expectations does management see in terms of the pipeline? Last time that we heard from them back in October, they talked about the strength and that it was a sustained momentum. That's the key here. Is this a bellwether, or is it something that we're going to see continue in future quarters? So it's not just about how the last 3 months of the year ended, but what we're going to see for the remainder of 2026.
Is there any more lingering concern about cockroaches? Because for all the talk about private credit, and Mark Lipschultz replied to Dani that it's on the banking side that's been the issue, and obviously Jefferies and First Brands is a poster child for that.
Yes. So Leucadia, which is a Jefferies fund, was tied up and is tied up in the First Brands debacle right now. So we're expecting potentially some updates from that. But overall, the bank has come out and given a lot of detail to the investors to quell concerns early on. They have said that they don't expect it to hit their bottom line, and that moving forward, this is something that they're maintaining, and they've put out various numbers to show the exposure. So it's not as if any of the numbers that they could report moving forward, we don't expect any surprises, just given how transparent the bank has been with regards to First Brands. But yes, the both macro concerns is something that the bank has referenced in the past, and those have not quelled. This is something that is continuing. We have geopolitical tensions that are bubbling up even further. So I expect that that's good for some parts of the bank with markets revenue. There's more trading with portfolio managers trying to manage their own exposure to various investments that they have, given all the changing geopolitical, just the environment overall. However, the credit concerns, that's kind of the other main topic, and I think that what analysts are really trying to dig into here. So we'll look to see if Jefferies has any further updates on potential other exposure that they have. All
right, well, we look forward to your coverage, and I'm just guessing we'll have you on the show again tomorrow if you're willing. Katherine Doherty covers the banks for us on the BN side. Coming up in the next hour, Goldman's Katherine Bordlemay reacts to labor data at the top of the hour. We got ADP this morning. Then William Blair's Matt Zimmer tells us if 2026 will see more deal volume than 2025. This is Bloomberg. We are 30 minutes into this trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. You just saw there, stocks pushing higher this morning, about 30 minutes into your cash equity trade. We're up 0.1%. But just given the fact that we hit an all-time record yesterday, that would put us at a new record today. The things that led us there was memory chip stocks. It was financials. They are taking a breather this morning, but even so, that's helping us a lot. And Matt, I believe maybe impacting markets this morning. We're just getting some breaking data crossing.
Yeah, we are we got this morning ADP, which we'll talk about with Mike McKee, but we're also getting a ton of other data. We heard ISM referenced earlier. That's coming in. New orders a little bit better than expected, as well as services employment, but prices paid a little lower. I guess that's good news. We're also getting JOLTS, which is huge. Obviously, job openings are what I'm watching most closely. 7.1 million, it looks like, compared to 7.7 for the expectation. So that's not as good. And that was also pretty much the same number we got last time, 7.6, 7.7 million. So we're not hitting nearly those levels, and maybe that's a concern. We're getting factory orders, durable goods. Let's get right over to Michael McKee, our international economics and policy correspondent, to break these numbers down for us. Where does your eye go to first, Mike?
Well, it goes to the services index, ISM, first, because it's much better than expected at 54.4.
That's because it's the first number on the screen.
Well, that too. Well, we knew that was going to, anyway. 52.6 was the prior number in November. But the underlying numbers are good as well. The production number is up to 56 to 56 from 54.5. New orders up to 57.9 from 52.9. That's a big jump. Employment comes in higher and expanding, 52 even from 48.9. So no contraction there, and that's going to have some people adjusting their thoughts on what we're going to get.
Anything
on
over
Friday.
50 is an expansion, right? Anything
Well,
under
roughly,
a contraction.
essentially that's the case. New export orders even up, 54.2. Imports still positive, 50.3. So the trade war not overall hurting the services economy. Let's take a look at JOLTS. It is 7,146,000 job openings, which is significantly down from the 7,449,000 in October. Remember, these are 2 months delayed. But people look at the quits level. The quits level went up to 2% from 1.9. People feeling a little bit better about being able to get another job, or at least they did in November. The layoffs level, layoffs rate 1.1% is down from 1.2%. So both of those, the ISM employment and JOLTS numbers, suggest that the labor market's in a little bit better shape than we had anticipated. Factory orders down 1.3%. Durable goods orders down 2.2%, same as they were last time. So the drop in factory orders basically is going to be in the non-durables category. Capital goods orders, non-defense ex-air, which is the part that goes into GDP, up 0.5%. That's what it was in the preliminary. So not a lot of news in the factory orders numbers, and those are for October. But we are getting some strength in employment in these indicators, and of course it all sets us up for Friday.
I was going to say, and all of that impacting markets, bond yields giving up some of their losses, moving slightly higher. Still, you can see there your 2-year yield, that's basically unchanged. The 10-year yield is still lower on the day, but not as low as it was. So it does lead this tension into Friday's numbers. As you say, Mike, it's going to be maybe the first set that we get that actually is more robust, maybe less affected by the government shutdown. What are the expectations there? And what difference will it make the fact that this is going to be one of the first sets of numbers that's not as distorted as the past ones?
Well, the forecast number, the consensus of economist survey by Bloomberg has been creeping up all week. It's now at 66,000. We were at 57, I think, when the week began. And as we get more numbers, that moves higher. But the one that people watch, Fed watches, is unemployment. And the unemployment rate is forecast to drop to 4.5% from 4.6%. Which does suggest that the labor market is stronger and the Fed doesn't have to cut. It just feeds into the narrative that they aren't going to do anything in January, and we'll see how the overall economy develops before they get around to their next meeting in March.
We have, on the Bloomberg terminal, we have the whisper function, WHIS go, which I don't know if it's the same for you. I'm not allowed to play. I'm not allowed to submit a number. You can make a guess as to what you think the non-farm payrolls number will be. And right now, the whisper number is significantly below the survey number. The whisper number is for 50,000, and the survey is at 70. So,
yeah, I think what you'll end up seeing is that we'll converge.
Here, Joe brought it up on the screen. This is what my goal for this week is to get as many clients as possible to submit, a guess, because the more it's like
you're getting paid per guess. What's going on here?
No, I just think it's more accurate.
It's like the NCAA basketball tournament bracket. You get bragging rights if you
WHIS.
It, right.
It says Chart TV Go. Joe, let's change that to WHIS Go, because then people will know with the sound off what they need to type into the Bloomberg.
Yeah, Polymarket's not fun. WHIS is fun.
WHIS.
That's where the action is.
But we've got jobless claims tomorrow, Challenger tomorrow. So by the time we get to Friday, I suspect that you'll see convergence between the whisper number and the survey number.
All right, Mike, thanks so much for joining us. Mike McKee there, international policy and economics correspondent. Joining us now is Katherine Bordlemay, Goldman Sachs Asset Management, co-head of equity client portfolio management. I was just listening to a couple of your guys on Odd Lots. Jan Hatzius was on there along with Ben Snyder, the new chief equity strategist. And you're bullish 2026 again, right? You expect, what, another 10% gain?
Yeah, exactly. I think, if we look first at 2025, it was very resilient, very strong. We learned diversification isn't dead. I think in 2026, you're going to see that theme of good equity returns, diversification working is going to continue. I think this year it's about policy. It's about profitability. Policy, it's a mixed bag. Obviously, there's good things coming through. We got tax, we've got monetary. But on the other side, we're talking about labor. I think the labor and consumer is something that we need to watch. We're in a K-shaped economy. We think that will probably continue, maybe even widen towards the back half of the year.
Because of the K-shaped economy, we've seen things like a lot of the consumer names not hold up, not do well. Staples really struggled. Does any of that change this year?
Yeah, I mean, look, the other theme this year, it's going to be all about bifurcation and selectivity. You know, not everything is working. The consumer is an area where I think some of the fallen angels have actually started to come back a little bit. But I think the big theme for consumer and frankly across the full U.S. market is really going to be about the big is getting bigger. Within consumer, I think, Matt, we talked about this before, there are 3 companies that dominate 60% of retail sales. Amazon, Costco, and Walmart. So focusing on the incumbents that are big, that have scale, that have the network and data, that's going to be the way to win this year. And
they're growing earnings at a faster clip. I was surprised to see that the median S&P 500 company is growing earnings at like 10, 11%, which is better than I thought it would be. But I guess those companies are growing earnings at a faster clip.
Yeah, and even, you know, the big are getting bigger, but I would say not all of the big are going to get bigger. So again, coming back to this, there's a lot of dispersion under the hood. You saw with AI towards the tail end of last year where actually some of the AI companies really didn't do that well. I think you really have to embrace the fact that market leadership is dynamic and it's changing. The dispersion is getting really wide, and that's through the consumer sector absolutely as well.
It's not only earnings that, you know, at that headline level look good. Operating margins look really good too. This was from Bespoke a couple weeks ago, that S&P companies are at their highest levels of operating margins in the last 30 plus years outside of a short period coming out of COVID. And estimates are even higher for this year.
Despite tariffs.
That's exactly where I was going to go. How is that possible?
Corporates are so adaptable. It's the resilience everywhere in the macro and in the corporate. And, you know, a lot of people are asking about, you know, we had great returns in 25. Is this all momentum? No, actually, it's just good profitability at the end of the day.
But could it also not just be good inventories that now are getting run down?
Good inventories. And then the next wave of this too, you know, it's actually AI being penetrated for corporates is pretty low, right? It's like 10 to 20%. That's going to be the next wave. You're going to see that come through as we get more tech enabled. Those things are going to come.
I worry about the inventory thing too. Maybe they just pulled a ton forward, but I worry about almost everything. On the optimistic side, I heard Ajay Rajadaksha from Barclays talking about AI driving growth. Not, you know, directly that people are using AI already to boost margins, but in the sort of K-shaped way that you mentioned. So stock gains have, at least on the upper end, helped the consumer go out and continue to spend money. Is that going to continue, you think?
Yeah, well, the stock market continues to do well like we think it will. Yeah, the wealth effect will continue to be powerful. And I think at the corporate level, I think that you're going to start to see that come through at the consumer. I think consumer first here and then more enterprises over time because they tend to move a lot slower.
So you get more of a wealth effect, but what difference does it make if you all of a sudden have, and we were talking with Lazard about this idea, that you all of a sudden have retail investors buying things like commodities, that gold has been really popular. If you start to get a rethink of where the incremental dollar is going, what does that mean for equities if you have a commodity super cycle, or at least copper, gold, these things becoming more attractive for a portfolio?
Yeah, so I think, you know, people like to have those as maybe diversifiers within their portfolio, but we still see clients that are very structural and strategic in their equity allocations. We're seeing good flows into U.S. equities. We're starting to see good flows into equities outside of the U.S. And actually very early days, but even small caps, which has been persistently the most hated asset class, we're starting to see an uptick of flows there. So what I'm hearing from clients is, these commodities are interesting to kind of sprinkle in your portfolio, but the core is stocks. They want to lean in there and they want more diversified, idiosyncratic sources across all different parts of the equity market.
So I'm learning over the past couple of days from you and from Goldman Sachs that the broadening out is happening, at least in earnings, and the Russell 2000 has been performing pretty well. And small caps are an asset that does well even in economic volatility, especially, I guess, because rates are going lower. How much do you expect that to continue?
Yeah, you know, small caps is the most unloved asset class, which is probably why I love it so much.
An underdog.
An underdog. I love a good comeback story. But they have been catching up to large caps pretty nicely. And if you think about it, a lot of the boxes are being checked. You've got a good economy, we're growing at 2.5%, M&A activity picking up, rates are going down. That's all helpful. I think if we can get the flows to continue to come in, that's a pretty important catalyst that can give the small cap trade legs. But the final thing I'd say, I think the success story with small cap is really not buying the index. Almost half of those companies are unprofitable. Will that index beat the large cap index? That can be a little bit more of a coin flip depending on the period. But I know the best performing companies will continue to come through the down in market cap part of the market.
That's always one of my favorite things about small caps. When people say they like the index, it's like, do you know what's actually in that?
Exactly.
Like, there's some very random companies that are probably unattractive just on their own.
Exactly.
Katherine, this has been awesome. Thank you so much for joining us. That's Katherine Bordlemay of Goldman Sachs Asset Management. And you are over 30 minutes into your trading day. A quick check on markets. After that data coming through, it looked better in terms of ISMs. The JOLTS picture looked better too. That means that yields started to come in. Some of the gains paired themselves, and also means that the S&P 500 is no longer rallying, Matt. It's unchanged, which if it remains this way, we will sadly not get another all-time high today.
True. Well, we just have to be over 69.44.
Right.
So at zero change, because of where we opened, that could happen, but it would be incremental. Coming up, space, AI, and crypto candidates lead the IPO pack this year. Matt Zimmer of William Blair joins us to discuss his outlook for the IPO market, plus M&A trends that we've been talking about throughout the show in 2026. This is Bloomberg Open Interest.
...2025 was a tricky year. There were a lot of headwinds. You started with, you had tariffs, you had Doge, you had an environment where people really didn't know the direction of travel around interest rates and inflation. And so, at least as it related to IPOs, there was a little bit of a risk off from investors wanting to invest in IPOs. 2026 is going to be set up for a very good year, both within private equity and just corporate M&A in general.
That was Carlyle Steve Wives speaking with us earlier on his outlook for M&A and an IPO market. And there are a big rush of IPOs in the pipeline this year that could rival or even top the pandemic era record. SpaceX, OpenAI, potentially going public, and all of that on top of a lot of M&A that we're expecting from Warner Brothers Discovery to otherwise. Joining us now is Matt Zimmer, Global Head of Investment Banking at William Blair. Matt, thanks so much. Great to see you again.
You too, thanks.
And it is a remarkable thing, just listening to Steve, how different things were in the beginning of last year versus where we ended last year.
Exactly.
I think about something like $4.5 trillion worth of M&A was done. How much bigger could 2026 potentially be than that even?
It's interesting. I was listening to Steve talk as well. I think we came into last year almost saying the same thing we're saying this year. We said it's going to be a big, strong year in 2025. And as he mentioned, we had a number of kind of events that occurred throughout the year, which it was a good year. In our industry where we play, kind of $200 million to $2 billion, it was a good year, not a great year, I would say. And the events that occurred, he mentioned it, tariffs as an example. When those kicked off, the industrial space, the consumer product sector, a lot of those companies just had to pause. They didn't know how to forecast their business. The rates that were coming out were very high. And that created a hiatus in M&A in those sectors. You kind of roll forward. Doge occurred, as he mentioned. The FDA, HHS, Department of Education, any companies serving the federal government in those capacities, biotech industry, any training businesses, they also took a pause to understand how that would impact our business. Get to the end of the year, the government shut down. FTC, the SEC, getting IPOs out at the same time. A few things along the way that created some obstacles. But all that said, by the end of the year, a lot of that dust had settled. People had visibility on how to forecast. Maybe tariffs were higher, but they weren't as high as they originally thought. The actions inside of Doge and that were kind of clear at that point. And so you saw the market start to open up, and you saw supply and demand actually come together a little bit. So we'll do 300, maybe 350 transactions a year total, call it 250 M&A, and then IPOs, follow-ons, continuation funds. We did 50 deals in December for about $34 billion of value. And you kind of get a sense that there is an opening that's occurring. The equity capital markets are opening, as he mentioned. We're seeing the IPO market open up as well.
Is that because, all year last year we talked about how big companies, obviously mega cap, but large cap companies were able to deal with tariffs better than small cap. And when I say small, I mean like tiny. We talked to a dude who makes like guitar pedals. And he was like, I don't know what to do, you know.
Right.
But the size that you play in, what do you say, 200 million to 2 billion?
2 billion, yeah.
Did they do as well at managing margins, at dealing with suppliers, at controlling costs?
Eventually.
As the companies that Katherine Bordlemay was just talking to us about?
Yeah, I mean, we have clients, I had a couple clients, nice, great businesses in the industrial space who said, listen, I just need to go negotiate with my suppliers right now. I need to understand my cost structure. I'm not in the world of forecasting my business into 26 and 27 just yet. But as these tariffs moved around and they ultimately settled, yes, they were higher, but the pain wasn't as much as people thought. And they picked their heads up, and I think buyers also got comfortable with it as well.
That's one disruption. The other big disruption has been AI and companies scrambling and figuring out how to deal with that.
Definitely.
Have there been any deals that have come to you and have kind of been like, we need to free up capital, we're trying to do carve-outs, we're trying to do this and that, but deals specifically for companies trying to get their hands around what spending on AI or just different structure of their company might be?
Yeah, absolutely. I mean, in the world that we play, I think like understanding the winners and losers in AI is one thing. But where we're kind of seeing the dislocation right now are all of these sectors we were just talking about that are potentially impacted by machine learning and artificial intelligence. So tech services, legal services, training services. We have a lot of clients that are in those sectors. And if you're a buyer trying to buy one of those businesses, you're going to think twice or at least do a lot of work around how much capital you're going to put $400, $500 million into a deal where that business, you know, there's going to be exposure one way or another. And how do they weather the storm and understand how they come out? So it has created heightened focus around businesses that are exposed to some of the nuances of AI.
I don't know if the term carve-outs is just new to me for a mechanism that's been around forever anyway.
Yep.
Or if, you know, in a world where M&A faces headwinds and IPOs also aren't necessarily preferred, the preferred exit for those companies that we just saw on that board, if carve-outs are just a great way for people to monetize assets. Like,
for sure.
What is it?
Yeah. I mean, I think there's an opportunity for people to continue to optimize their profitability and their focus and strategy going forward. So there could be legacy businesses inside of a large corporation that they say, listen, our pricing, our multiple, the value we'll get for this business really optimizes our business going forward. Let's think about carving that out and selling it. And there are a lot of buyers out there who like to do those deals.
Yeah.
They like the complexity, like to figure out how to carve it out, make it a standalone business, and then grow it. So it's a big trend.
But by the way, you mentioned sort of some of the IPOs that we were looking at for next year. They're all huge IPOs. I mean, if it's SpaceX or OpenAI.
Gigantic.
Some of the ones that we saw last year, we're talking to Steve Wise about Medline, the biggest IPO of the year. Is the IPO market, and maybe generally the M&A market, considering EA was a giant deal, Warner Brothers Discovery is going to be a big deal, is the market just more open for large mega cap deal than it is for mid cap or smaller cap?
I don't think so. I think there are a lot of these large private companies that have scaled before going public through these new technologies, whether it's space or AI. Eventually they have to get out and get public. But in 2026, my hunch is you will see an opening of the equity capital markets business. IPO activity should increase, all things being equal. And I think it'll be a mix of kind of mid-cap and some of these mega IPOs as well.
But you work with private capital on a ton of deals, and I guess sovereign wealth probably too. And are tombstones just getting bigger? Are there more people come to the party?
I think the capital coming into these deals is getting different, is the way to think about it. Some of these big transactions, if you think about, we talked about it last time, you know, there's $3.7 trillion of portfolio companies housed inside of private equity firms today, worth of portfolio companies. That's a gigantic number. It's the biggest it's ever been. These private equity firms have been holding these businesses for an average of 7 years. 3 years ago, it was 5 years. And so there's a big inventory of companies that are going to come out. Because they've held them longer, they're getting bigger. And as you think about transactions, to your point around sovereign wealth funds, as an example, they are a big buyer and a big co-investor in a lot of these bigger deals right now, where a private equity firm will come in and say, we'll buy this business. Can we get some money from the sovereign wealth funds as well as a co-investor?
Portfolio companies are like half of global money market fund holdings.
Yeah,
like
I mean, it's a big number. And at some point, that pipeline and that inventory of companies needs to open up.
Thank you so much.
Thank you.
It's always a pleasure having you.
Appreciate it.
I hope you come back.
Thanks.
Matt Zimmer there from William Blair. Still had a dramatic chase on the high seas that took forever. Finally comes to an end. The U.S. forces caught up with an oil tanker after 3 weeks of a chase. We'll talk about it next. This is Open Interest. Let's get a check on what's going on in the markets right now. You can see the S&P 500 is down just 0.06%, but the 69.45, that's the level that we need to hit for another closing high today. Looks to be elusive. right now trading at 69.40. The NASDAQ actually a little higher, so this is a flipped image of what we saw in futures. The 10-year yield at 4.16 is little changed, and Brent crude down to $60.22 a barrel. Coming up, volatility continues to loom. Speaking of crude, for the shipping industry, we'll get the view from the top.
We're going to let the oil flow, sell that market to United States refineries and to around the world to bring better oil supplies, but have those sales done by the U.S. government and deposited into accounts controlled by the U.S. government. And then from there, those funds can flow back into Venezuela to benefit the Venezuelan people. But we need to have that leverage and that control of those oil sales to drive the changes that simply must happen in Venezuela.
U.S. Energy Secretary Chris Wright speaking at a Goldman Sachs conference. Now, he made those comments after President Trump announced Venezuela would relinquish up to 50 million barrels of oil to the U.S. That's worth about $2.8 billion, saying the proceeds would benefit both Venezuelans and Americans. Joining us now is Bloomberg oil strategist Julian Lee. Julian, after the events of the weekend, the consensus was that it would take a while for Venezuelan oil to get online, and that there was corruption, there was aging infrastructure that made it all difficult. This is now a White House that's talking about immediate barrels of oil, be it from captured tankers or elsewhere, coming to the U.S. How much of an incremental difference would that even make at this point?
Well, I don't think it's going to make an incremental difference. I mean, this is the oil that Venezuela has been producing in any case. That oil, up until this weekend, was going largely on these shadow fleet tankers, vessels operating outside of any sort of Western oversight or Western services, and most of it was going to China. What's going to happen now is, instead of going to China on these rusty old ships, most of it looks like it's going to go to the US Gulf Coast, and it will get processed in refineries there, competing no doubt with heavy Canadian crude, which is the most similar grade, and perhaps some Mexican barrels as well. By the sounds of what the Energy Secretary was saying, there will continue to be sales which will likely go to Chinese refiners as they are now. But this isn't incremental oil. This is oil that Venezuela has been pumping. This is the 1 million barrels a day or so that it's pumping at the moment. And some of this, perhaps this initial 50 million barrels that's being talked about, is oil that is currently sitting in tankers that hasn't been able to move because of the blockade. I think they'll find out that it's actually worth quite a bit less than the $2.8 billion that they're talking about. That seems to me to be based on a benchmark oil price for something like West Texas Intermediate or Brent. This very heavy Venezuelan crude is probably selling for anywhere between 15 and 20 bucks a barrel, less than that.
Wow. So at that kind of discount, is this heavy crude that comes out of Venezuela, Julian, and forgive me if I, am not as schooled in this, good for U.S. refiners? Because you mentioned that the Canadian oil, some of the oil these refiners use is also heavy. What's the difference in terms of these grades, weights of oil?
Well, I mean, the Venezuelan stuff is extremely heavy. I mean, the Venezuelan stuff is so heavy that you can't pump it through a pipeline unless you dilute it first. And so what has been happening, and this has been going on for years, is that Venezuela has been importing typically naphtha, in some cases very light condensates, to blend with its crude oil to allow it to flow. Even then, what comes out at the end is still very heavy in the spectrum of crude oils. I mean, it's right at the other end of the spectrum from the light oils coming out of the shale in Texas and New Mexico and elsewhere. But it's much more similar to the very heavy oil from the oil sands in Western Canada and some of the very heavy barrels from Mexico. And there are a number of refineries on the Gulf Coast that were designed specifically to process those very heavy oils. And they will, I think, benefit from this, because as more Venezuelan oil comes onto the market that they can access, that increases competition among the sellers, and that can only be good for prices from a refiner's point of view.
Julian, great to get some time with you. Really appreciate it, and the education you give us with your columns. Julian Lee covers oil for us, covers the industry for us out of London. Now, let's get more on how geopolitics are impacting the shipping industry. We're joined by Tom Lister, CEO of Global Ship Lease. It's an independent owner of container ships with a diversified fleet of mid-sized and smaller container ships. And I gather you're not active in oil, certainly not in Venezuelan oil, Tom, but how does all of this, what we've watched happen over the last week and over the last number of weeks, affect the entire industry?
Sure. Well, first of all, Matt, thanks very much for having me on. I would say from a containerized trade perspective, what we're seeing in real time in Venezuela at the moment doesn't really move the needle from a global perspective. I mean, obviously, the Venezuelan economy has been deteriorating over the course of the last decade or more. And as a result, containerized volumes both into and out of the country have come down very, very substantially over the course of those last few years. So at the moment, if you were to look at overall volumes both into and out of Venezuela, they're less than a fraction of 1%. So what's happening in Venezuela doesn't really affect us hugely, or the industry hugely. However, I would say it does fit into a sort of a broader backdrop of very significant disruption that's been taking place, geopolitically driven disruption that's been taking place over the course of the last 12 plus months. And there, perversely or counterintuitively, disruption tends to be good for the industry. And why is that? If you have disruption and unpredictability, that means that there's a lot of value to optionality. And we're providers of ships to the shipping lines themselves. And for them, capacity is optionality. So they can move the pieces of the chessboard around, as the macro changes. So disruption, unpredictability, that's good. That's good for our business. And that's precisely what we've seen. These guys have been fixing our ships consistently to the extent that we no longer even have any open positions, really, for 2026.
Well, what about just the routes of these ships in general, Tom? Even if you're not being directly affected by Venezuela and it's just a small piece of the overall picture, things like Caribbean and Gulf routes, or even near Scotland in the UK, where the US boarded and seized this Russian tanker?
Sure. So I would say that, again, putting this in the context of the last 12 months or so, what we've seen is a very dramatic shift in containerized trade flows. So, up until, I guess, the end of 2024 or so, containers tended to flow in pretty fat pipelines from China into the US, China into Northern Europe, and to some degree across the North Atlantic. What we're seeing now is that both the US is looking to diversify its sources of cargo. So trade flows into the US, although the volumes are staying up, are becoming more fragmented. And the Chinese, principally the factory of the world, have been actively looking to diversify their export markets since Trump 1.0, since roughly 2019. So we're seeing a huge fragmentation of supply chains, containerized supply chains. That's driving a lot of inefficiency into the system. And once again, that inefficiency, weirdly, is good news for people like us, because to move the same volume of cargo, the shipping lines need more ships, more capacity, and that's precisely what we're providing. So a lot is changing at the moment.
I was listening to Ruchir Sharma earlier this morning on Bloomberg Surveillance. He wrote the book, What Went Wrong with Capitalism, and Paul Sweeney asked him about globalization. Is it dying down around the world? And Sharma said, no, it's just that the U.S. is pulling out of it and global trade for everybody else is picking up. Do you witness that as well?
That feels about right. And, just to put things in context, even before all of this disruption began, the U.S. represented roughly 13% of global containerized trade flows versus roughly 35% for China. So you're right. The U.S. perhaps is stepping back a little bit from globalization, but they're by no means the largest player in the picture, number one. And I think I'm not sure I would categorize it as a step back completely from globalization. It's more a rejigging of the picture. I don't think there's going to be import substitution, at least not in the very short term, implemented by the US, but they're going to be sourcing more or less the same goods just from different locations. So it's the same volumes moving, and it's worth saying that global trade was up in volume terms 5% year on year last year, despite the noise. So it's the cargo is still flowing, but it's just coming out of different areas, and it's looking different. Maybe there's more regionalization. Maybe the networks are more complex.
Tom, just before we let you go, what is your outlook for 2026 when it comes to container volumes? I just wonder how much tariffs are still suppressing or igniting some of the volumes coming in, given the big rush to get things in before tariffs took an impact, the confusion of 2025. What does 26 look like?
Yeah, there is the multi-billion-dollar question, Dani. And the truth is, neither we nor I would suggest anyone else really has a clear handle on that. And in the face of just tremendous uncertainty, the way forward for everyone really is to build as much slack into the system as possible, because despite all of the complexities and the changing environment, consumers are not getting any less demanding. Everyone still wants the goods they order online tomorrow or even the same day. So if people are going to meet that in this ever more complex environment, there needs to be more slack in the system. And that's essentially exactly what we're seeing. In terms of growth, I would expect it to more or less match GDP growth. So if global GDP grows at 2.5% to 3% or so, I would expect container volumes to grow at more or less that same rate.
Tom, this has been so interesting. You have to come join us again. Tom Lister of Global Ship Lease, thanks for your time this morning. Now, coming up on the show, the White House says President Trump won't rule out force to acquire Greenland. We're going to get the latest, and the wild ship chase has now come to an end, to tanker chase, rather. That's all coming up next. You're watching Bloomberg. Tensions have been escalating between D.C. and Denmark. The White House saying that President Trump is considering many ways of acquiring Greenland, including the use of military force. Joining us now is Joe Doe, Bloomberg economic statecraft reporter. By the way, I should say a viewer wrote in basically taking issue with our use of the word acquiring, saying you can't acquire it. Greenland's not up for sale. That hasn't stopped companies from doing hostile takeovers. I mean, what could this possibly even look like, Joe?
I mean, I don't know. I went to Greenland.
That's the right answer.
I went to Greenland back in May, and the story we produced was we followed around this individual who is a former Trump administration official who now is in the private sector, who basically connects companies with government. And part of his trip there was this rare earth deposit. And he was trying to see it and kind of verify it and go back to the administration and say, this is a good project that we should consider. So there's still that concept, right? That there's a business play on Greenland that the United States can be a part of. The conversation over whether or not there's going to be use of force, I think in the past day or so, we have seen certain officials come out and kind of downplay this idea of use of force to take over Greenland. But I think an important thing, like you said, the hostile takeover is, when I was talking to Greenlanders while I was in Greenland, if you were even talking to the most extreme, right, who are big Trump supporters, they say, listen, we don't want the United States owning us. If we're upset about Denmark being effectively owning our territory, then why would we want someone else to own us if we want true independence? And I think that's such a basic thing to just keep in mind around all of this. I also say, we shouldn't just discount the President of the United States talking about this. We shouldn't just say, oh, forget it, it's just words. Words matter. Words matter. That's why Danish officials have been coming out over the past few days saying what they're saying. If they attacked, that'd be effectively the end of NATO. And you can't do this. This breaks international law. All of these things are important. But on some level, there does seem to be a bit of a disconnect between Donald Trump seemingly speaking a bit off the cuff and European officials having to come in and say official European official type of comments.
They've been in management classes, those European officials. And look, my dad always used to say, why buy the cow when you're getting the milk for free? Okay, we don't have this army base on Greenland for free.
Right.
But essentially, we get use of Greenland in pretty much whatever way we want, right? And of course, it's part of NATO also. So, we're on the same team. And I saw earlier that Trump tweeted something like, I doubt NATO would come to our aid if we really needed it. I doubt NATO would be there for us if we needed, he said, which, I mean, they've been there every other time we've needed, right? So why do we want it so bad?
Well, listen, Greenland is important, especially in the Arctic Circle, right? You have seen increased activity in the Arctic region. There's much more ship activity among the Russians and the Chinese, and the United States and Canada understands this. The United States understands this.
But we run it already. Why does it matter if our name's on the deed?
I'm trying to get to some sort of sensible idea here, and I think that's what you're asking, which is the Pentagon is very aware of this, and I think the Pentagon, their job is to defend the United States around the world. And that's a fair thing to do. Somebody has to be looking after you and I. And maybe you and I would think of it differently as civilians, but their job is ultimately we have to prevent bad things from happening. There's increased activity in the Arctic Circle. The United States is far behind on the number of icebreaker ships. You know, if the United States has 2, Russia has between 20 and 40. These are the type of questions that technical people think about on a daily basis within the Pentagon. So you marry that with the conversation that is being had with the President of the United States, who has said in his previous administration that he sees some sort of real estate deal around Greenland. And I think you have to start trying to make the best connections that you can. Is what he's actually saying the truth? I don't know. But it's on his mind. It's part of the Western Hemisphere. We just removed the president of Venezuela, which is part of the Western Hemisphere. We just put out our new national security strategy in November that outlines that these things are all part of the same hemisphere. Right. So maybe it's coincidence, but maybe there's also something there for all of us to have to pick through and try to figure out.
Joe, it's great to always get your take. I wish we had you on more often. Joe Doe is our statecraft reporter. He's obviously incredibly busy, so we only get him sparingly. Let's continue on this sort of geopolitical bent here, because there has been what some would describe as a dramatic chase across the Atlantic, ending with U.S. forces finally seizing a Russian-flagged oil tanker accused of sanctions violations. Originally, of course, it came out of Venezuela. The UK's Ministry of Defense says the U.S. requested support in this operation. So it looks like NATO is working together on some level. Wayne Sanders, Bloomberg Intelligence senior defense research analyst, joins us now. You have so much experience in defense at the DOD. You were a colonel in the Army, et cetera. Do you understand why the U.S. would want to wait so long before getting on board this tanker? Because surely we can catch one more quickly than, a 3-week chase would imply.
Yeah, absolutely. You asked me 2 weeks ago, hey, why are we still just following this? I think at that point in time, it's really just a strategic. It's really looking at presidential authority and when they want to be able to do it. It might be something as simple as where's the vessel going to go next? Is after it's seized, is it going to be somewhere, in UK, Scotland, or is it going to go into Iceland? Because it's easier for us to be able to place it there. Just let them drive it the rest of the way as they were heading towards Murmansk. I think that might be one of the biggest reasons. But a lot of it just, I think, is timing. They could have done it in the Atlantic a lot sooner than this, but this is the time they chose.
And Wayne, going back to what Matt pointed out, the fact that they requested help from the Brits, that the UK gave them that assistance, and what the U.S. is trying to do right now, be it in Venezuela, be it with these tankers in international waters, a renewal of the Monroe Doctrine, is this something that the U.S. would need NATO support for, that they would need their allies to rally behind them to help the U.S. with these types of different actions militarily? And how complicated is that by kind of the relationship that's been evolving between the U.S. and its allies?
Yeah, I think that it's important here. One of the key things is that it was Coast Guard vessels that did it, along with the support from the UK, overflights from military as well. Why that's important is because the sanctions that are being set up in the blockade, right? The blockade down in Venezuela is going after the shadow fleet. It's going after stateless vessels that are carrying black market crude oil, right? This is one of the key pieces. towards what they're trying to do. Law enforcement, this was a sanctioned vessel from a Biden administration in 2024. So this is one of the key pieces as to why they went after it the way they did. But if they were trying to expand what this looks like, it is always going to be critical, I think, even in the public eye, that they have that type of support. And being able to see that from the UK today was really important.
I just want to ask, Wayne, your take on Greenland. I get that it's strategically incredibly important that the Russians have a lead on us in terms of, subs in that strait. But would we get anything different owning Greenland than we have now with we have the only base on Greenland?
We do. I think the strategic importance there is a couple. As Joe mentioned earlier, is rare earths becomes obviously a big piece. From the strategic military side of the house, everything that we do from polar satellite coverage, things that are going on in that area. If you're looking at air and missile defense, early warning capabilities so that we can see. If you look directly over the North Pole and you look at where Greenland is, it actually drastically reduces the amount of space, obviously, to reach the United States. So a hypersonic missile can actually reach the United States faster over the pole than it can otherwhere.
Wayne, sorry, I got to cut you off because of a break, but really appreciate your time as well. Wayne Sanders of Bloomberg Intelligence.
Markets up here about over an hour after the market open. We are on track for another record, up 0.08%. I just want to point out what Intel is doing today, Matt. Not on any particular news, but look at this. It was up more than 11% at one point today. It's well positioned geopolitically. Maybe that's part of it after all the action that the U.S.
I think it could be part of the pro-sec trade as well. Intel getting back to an all-time high that it hit on, or a 52-week high that it hit on December 3rd. Coming up tomorrow, Ann Berry, I'm pleased to say, joins us at Threadneedle Ventures. Marianne Bartels of Sanctuary Wealth, she, the most probably famous technical analyst, and Bob Profusek of Jones Day as we continue to explore M&A. This is Bloomberg Open Interest.